Hi, I'm Pattu from FreeFinCal, and in this video, let's discuss how to buy your first stock. Now, at some point of time, many people who start investing in equity via mutual funds want to extend their portfolio into stocks. But the problem that a newbie faces is that there's so much information on stock investing that is impossible to know where to begin, what to read first, and so on. This is certainly the problem I face. I hate people who keep telling me go start reading Warren Buffett's letters to stockholders or his books and so on, or books about him and so on. I hate that. My way of looking at stock investing is to pick stocks quickly without much research. Start slowly. Start with safe stocks, that is relatively safe stocks, and have a long-term portfolio of 10 years, 20 years, 15 years, or maybe even lifetime. But that doesn't mean you hold the same stock for your lifetime, but have a stock portfolio for a very, very long time. And so on. So this in this video, I'm going to focus on how to pick stocks quickly without much research. This was not possible a couple of years ago, but now thankfully it is. And that's what I'm going to explain. I've already done some videos on this before. You can have a look at it. Also written extensively on this at FreeFinCal. So my suggestion to newbies is to focus on a concentrated portfolio of not more than 10 stocks. But I would recommend that they start with 5 large cap stocks initially. For first 1 to 2 years, have just 5 large cap stocks. Just observe the market, learn, get some experience of volatility, and then they can gradually add 5 more mid-cap stocks. But then even if after adding the 5 mid-cap stocks, the large cap proportion can be 50-60% of the portfolio. So that's just 10 stocks for the long term. And so we'll talk about how to, in this video, I'll talk about how to add those 5 large cap stocks. In the next video, I'll talk about how to add those 5 mid-cap stocks. So to do this, let's go to nseindia.com, which is the National Stock Exchange website. Go here, go to products, go to indices, and then go to about indices and click on strategic indices. So strategic indices are essentially a combination of active investing and passive investing. Now, the usual indices that we see, that we hear about every day, the Nifty, Sensex, Nifty, Next 50, and so on, they are all based on the free float market capitalization. That is, market capitalization essentially means the number of stocks that are available for trading, freely available for trading, times the market price. So if the market cap is high, then so essentially the stock will have more weightage in the index. For example, in the Nifty 50, they are the top 50 stocks in terms of free float market capitalization on the NSE. The Sensex is top 30 stocks on the BSE. The Nifty Next 50 is the next 50 stocks in terms of free float market capitalization. The Nifty 100 is the top 100 stocks, which is Nifty 50 plus Nifty Next 50, and so on. Instead of choosing stocks purely by their market capitalization, there is a way to actively select stocks. And this combination of actively selecting stocks and then creating an index out of it and following only that index. So that's a combination of active selection and passive investing. That's called a strategy index. They're also called as smart beta indices because they take into account risk factors not traditionally considered. So there are multiple strategy indices, and the NSE keeps adding them, to them every now and then. I have several posts on strategic indices. I'll link a few here. So what I want a new stock investor to focus on are just 2 indices from this. So Nifty 100 low volatility 30 index. So this takes 100 stocks which have the highest market capitalization in the NSE. That's the Nifty 100 index. And from that 100 index, it looks at the daily up and down movement of the price and how much it moves up and down for the last 1 year. And it lists 30 stocks which have the lowest daily price volatility among that Nifty 100 stocks. And I have shown earlier that Nifty low volatility investing is a fantastic way to invest in stocks or in equity in general as an index, because many people believe that you have to take more risk to get more return. That's completely not true. With low volatility indexing, you can take less risk and get more return than Nifty Next 50 or Nifty 100 or Nifty 50 and so on. I will show a proof of this. So here, if you look at this, there are 2 research papers from the NSE about low volatility investing. You can read that. I also have some plots on that. So this is the full list of the 30 stocks. It's available as a CSV file. There is a fact sheet which is updated every month. Of course, this is also updated every month, and this tells you the method by which it's calculated. You can read that. So I'm going to show you the fact sheet now, which is a present fact sheet. So this is the fact sheet will be published at the end of every month. So in this fact sheet, you have the top 10 stocks by weight. The weight of all the full 30 stocks is not available. Only the names of the full 30 stocks and the top 10 stocks with weightage is available. But that's your list. Just pick 1 or 2 stocks from that. That's it. You're done. I mean, don't worry too much about it. These are stocks which have got large enough market capitalization. That means they are liquid enough. That is, large trades of these stocks will not affect this price too much, and they have low volatility, and they're solid names. They're solid, well-established companies. For a newbie, they should be looking at buying such stocks first and gradually developing their risk appetite. Now, the problem is with all stock investors is that they want to start with small cap stocks, mid cap stocks, and so on. Don't start with expensive stocks, good stocks that the market is willing to pay a heavy price. See, when you want to think of it as buying a smartphone or a laptop, right? I mean, how many times are you going to change your laptop? Of course, people, I can't say that about smartphones because people change their smartphones every 2 years. But think of a laptop. A laptop is expected to work for most people. It's expected to work for like 3 to 5 years. And if you want to buy a laptop with a decent processor, a decent RAM, preferably some graphics RAM, good hard disk space, and so on. So for this, you have to pay some money. If you want to, there is a laptop available for 30,000. There's a laptop available for 2 lakhs. There is a difference between the 30,000 laptop and the 2 lakh laptop. It's not just price difference. The specs are different. So when you shop for a laptop, you look for a laptop with the decent specs, which means that you are willing to pay that price. Of course, people are looking for discount sales and so on. That's a different matter. We'll come to that kind of value investing later. But buy stocks which are well established, which have good companies, solid businesses. That's the reason why the volatility is less. And low volatility investing is a form of what is called as momentum investing. There's a video on this. You can look at that. So that's your shopping list. So that's one index you can consider. You can also consider another index, which is the Nifty 100 Quality 30 Index. So there are 2 Quality 30 indices, Nifty 200. So this considers 30 stocks, 30 quality stocks from the Nifty 200. This considers 30 quality stocks from the Nifty 100. My suggestion is to start with Nifty 100. This is a fairly recent index. I mean, they don't have much data available for this. So I'll explain what this is. So here, 30 stocks again are chosen from the Nifty 100. And these are stocks with a high return on equity. So essentially, return on equity is net income. That is the profit after tax and all expenses divided by the net worth of the company. So that's a measure of profitability. Then it finds out how much debt the company has got. So it must have low debt to equity ratio. That is the amount of money that it is borrowing divided by its net worth should be low. And then its earnings per share, that's the profit per share, should have low variations. It should grow, and also it should not be volatile. It should not be high 1 year, low 1 year, and up and down and so on. So it should be the volatility in the earnings per share should be low. So these are the 3 criteria, and equal weight is given to return on equity, debt to equity, and earnings growth volatility, and the score is calculated known as a quality score. So a company with high ROE, low debt to equity ratio, and low earnings growth volatility, that is it should be steady. Then a stock has a quality score which is high, and so from the 100 Nifty stocks, the 30 stocks with the highest quality scores are picked, and the stock with the highest quality score will have higher weightage. And in this case, in the case of Nifty low volatility 30, the stock with the lowest volatility will have highest weightage. So coming back to this, so these are the 30 stocks currently having the highest weightage. You will notice that some of these stocks are also found in the low volatility. So that's also a good way. So take these two indices, find out the common stocks and just buy them. That's it. Of course, some of these stocks are expensive. I mean, you have to pay 1,000 rupees, 2,000 rupees for every stock. That's quite fine. I mean, don't get into this habit of buying cheap. Buying a good company cheap is different from buying a cheap stock. I mean, it's very easy to buy a mid cap or a small cap for a much lower price, for 200, 300, 100 bucks, whatever. But when you start, I think it's better to start right, buy solid companies and slowly, gradually accumulate them. Even if you can buy only one stock a month of HDFC Bank or Asian Paint, just buy that. It's okay. Don't worry about buying multi-baggers, potential multi-baggers. These are multi-baggers already. But they still, from the price that you are buying, they still have the potential to increase your money over the long term, because they're solid businesses, and the need for these businesses are not going to diminish. If you actually look into these balance sheets, they'll be pretty rock solid. So that's a quick way to buy. How long would this take? In like 30 minutes you can buy. You just need to getting a demat account will take longer than picking stocks if you choose to do it this way. So this is my suggestion to pick stocks. Pick your first stock, and new investors can choose this. Of course, there are other indices as well, but out of these, I prefer and the reason for that is, now in this graph, I have shown rolling return over 10 years for about 5 indices. The red line is Nifty 100 total returns. The blue line is Nifty next 50 total returns. The Nifty large mid cap 250. So this is Nifty 100 plus Nifty mid cap 150 taken in equal proportion. So Nifty large mid cap 250 is an index that Motilal Oswal is coming out with an index fund for. Don't worry too much about it. If it confuses you, just forget about the pink line. Nifty 200 quality 30 it takes quality stocks from the top 200 stocks. I had just talked about Nifty 100 quality 30. This is Nifty 200 quality 30. The reason I'm not plotting Nifty 100 quality 30 is because the data available is quite less, so there's no point. But the essential logic is similar. Maybe the returns would be a little lower than Nifty 200 quality 30, but that's okay. Then the black line is Nifty 100 quality 30. Notice that. Look at the black line and the red line. Notice the black line and the green line, and compare that with the blue line and the red line. So over 10 years, these strategic indices have comfortably bet Nifty next 50 and Nifty 100. And there are 926 10-year data points in every one of those curves, every colored curve. That's pretty decent. Of course, we still need more history. I'm not saying it. This is conclusive evidence but that's pretty decent history, and you can't ignore that history. And if you actually look at the rolling risk over these 10 years, the black line and the green line have the lowest risk. The blue line, which is Nifty next 50, has the highest risk. And look at that. I mean, you're getting high returns at low volatility. This is awesome. And there are currently there are no indices to follow these two strategic indices. There are no index funds to follow that are tracking these strategic indices. But You don't need them. If you want to start stock investing, just pick a few stocks from that. You might even beat these indices because your concentration and weights will be different. That's easy. Why waste time studying about valuation and this and that? And oh my God, all these people in Twitter with a blue tick and stock market gurus will make it sound as if stock investing is so complex because they have a conflict of interest. They have their own companies to sell, but it's so trivial. As long as you understand that these are large caps and you need to give them time for it to perform, this is fine. Of course, you can also choose mid caps this way. So I'll consider that in the next video. But this is a video about choosing your first stock, and that's it. It's as simple as that. Just go over to the NSE page, choose a stock from Nifty 100 quality 30, or choose a stock from Nifty 100 low volatility 30, or you can compare the portfolios and look for common stocks and choose one. Please note that suppose you choose one from the top 10 stocks, these stocks will not remain in the top 10 every month. They will fluctuate. But as long as the stock you hold is in the top 30, that is actually in the index of 30 stocks, it's fine. You can keep holding it. If the stock drops out of the 30 stock index, if the stock actually is removed, then you must be ready to sell your stock and buy a new stock from the top 10 or from the 30 index. So that be prepared to do that. Because you can't just hold and get emotionally attached to stocks. But if you do that, if you track systematically, I think stock investing can be just as easy as mutual fund investing without too much worry. In fact, if you look at this, the choices, if you just stick to these, the choices are even less compared to a mutual fund. So that's what I wanted to say in this video. I'll catch you again in another video. Bye bye.